Hello and welcome to Mercer Capital's webinar, Succession Planning for RIAs, Transition with Confidence. Our two presenters for today's session are Matthew Crow and Brooks Hamner. Matt leads Mercer Capital's investment management industry team, and Brooks is a senior member of the team. Together, they have decades of experience in the industry. Before we begin, we want to make you aware of a few housekeeping items. Please use the chat box for any technical issues you might experience during the webinar. For questions related to the material in the webinar, please use the Q&A box. We will answer any questions at the end of today's session. You can find additional information in the Resources tab, including more information about our speakers, white papers to download, and links to other content that might be helpful to you. Now, let's turn it over to Matt and Brooks.
Thank you, Sarah, and hello to everyone watching today's webinar. My name is Matt Crow, and today Brooks and I will walk you through what we see as some of the more overlooked aspects of succession planning. When I think about succession planning, I think about what Will Rogers once said about the weather. Everybody talks about it, but nobody does anything about it. If you're listening in today, you've probably decided that you need to do something about succession, but you need to know more first. There is, frankly, a lot to know. What we're not going to cover is the typical run-through steps of a succession plan or walk you through a case study. Both of those are useful exercises, but there are plenty of examples of that kind of presentation already out there. Instead, we're going to cover as much useful information as we can in this hour, some of which is drawn on market data and much of which is from our own experiences. If you'd like to explore this topic further with us, feel free to reach out after we wrap up today. I think one myth of succession planning is that in any way, it's an optional exercise. The reality of every business, especially closely held ones, is that they will sell. Run properly, businesses outlast careers, employees, and owners. When we get a call from a prospective new client, they fall into one of two groups: voluntary transfers and involuntary transfers. While we're happy to hear from everyone, clients calling us to help plan a succession, develop a buy-sell agreement, or assist them with a transaction are in a better place than those who call us because of shareholder disputes, an estate matter, or a divorce. Today's topic, succession planning, is an opportunity to transfer ownership to the benefit of both the transferor and the transferee. But doing that requires a considerable level of planning. And the reality is that a surprisingly large percentage of RIAs do not have a succession plan in place. This page shows some related data we've compiled from several different studies on the topic, conducted by Franklin Resources, Cerulli, and Schwab. And we've seen corroborating data from Dimensional Fund Advisors, Fidelity, and others. You'll see looking at this that even though more than a third of financial advisors plan to retire in the next 5 years, 2/3 of RIAs don't have a formal succession plan. Less than half of advisors over the age of 65 have a formal succession plan. And what we notice looking at this data is that 2/3 of RIAs expect a change of ownership in the next 5 years, even though only a small percentage of firms sell to third parties in any given year. Most ownership changes in RIAs are internal, and we would note that most of the best performing RIAs have a formal succession in place, even those who plan to sell to outsiders. Before I go any further, I want to ground this discussion in the overall goals of succession planning. Succession planning has implications not just for ownership, but also for your RIA business and your clients. All of the stakeholders in an RIA benefit from a smooth transition of leadership and ownership. If you think of succession in terms of business continuity, it reduces some of the psychological stress of succession. We find that often succession issues aren't about spreadsheets so much as they are about the push-pull of founding generation leadership and generation 2. By the way, if you can get from the founding generation to generation 2, succession following that gets a lot easier. Founders have very different career experiences than successor generations, and it's normal for both parties in a succession process to feel like they're not being heard. But ownership is only one aspect of succession. The business, the employees of the business, and the clients of the business all need for a successful transition of ownership. Now, the second generation is keenly interested in the economics of succession, but employees are equally interested in the stability of their careers. If your staff turnover starts increasing, it could be a sign that employees are growing concerned about the long-term viability of their employer and of their careers. Clients, of course, don't hire investment management firms with anything less than a very long-term horizon, and they want to know that your RIA will be around for their needs. When clients start asking questions about ownership continuity, it's getting late in the game on your succession plan. Asset managers are used to consultants asking about business continuity in the normal course of their work. Wealth managers don't get those kinds of questions from clients until the situation starts looking obvious. And of course, we all know regulators increasingly care about this topic. In general, if you put the business first and think about succession in terms of managing your RIA and providing for continuity of the business, it'll put some of the emotional aspects of succession in proper context and help you make your succession plan a success. Now, Brooks is going to take over now and get a little more specific about all the different types of succession issues that we've encountered and how we see clients dealing with them.
Thank you, Matt. So your unique succession plan considerations depend on the ownership structure of your RIA, which we generally find falls under these four categories. The most common type we see for the RIA industry is the first one you see there in your top left quadrant, and that is an internal concentrated ownership position. That's typically where the founder or founding principals have 100% equity in the business, and they're actively involved in the business, control all the decision making, et cetera. That's the most typical model, and it's usually found in smaller RIAs and also newly formed RIAs as well. So that's the most typical version, internally concentrated ownership model. Moving from left to right, a less common model that we see for the RIA industry, but is growing in popularity, is the sponsor-backed or the externally owned but concentrated ownership structure. And that's typically when the founder or founding principals have sold either a majority interest or a 100% equity interest to a financial sponsor or financial buyer. Typically, that's a private equity firm, or increasingly more common is the RIA aggregator firms that you're probably all familiar with. And that's less common, but we're seeing that particularly over the last 5 to 10 years with all the proliferation of the RIA aggregator firms out there and their acquisitive nature, that is becoming an increasingly popular route if you're looking to sell to an outside buyer. Moving to the bottom left corner, it's less common than the concentrated internal ownership structure for an RIA, but it's also growing in popularity, is one that is still internally or employee owned, but that ownership is broadly distributed not just to the founding principal or the founding partners, but also to a broader group of employee ownership. Usually that's the key advisors, the key managers, chief investment officer, et cetera, C-suite. But it's a larger group of insiders that have usually 100% equity in the business. So we see that quite a bit in the RIA industry, and it's becoming increasingly popular in recent years as well. The least common or least popular ownership model out there, but we do see it sometimes, is the one at the bottom right, and that is the externally owned, widely distributed ownership base for an RIA. Typically, that means it's either gone public, it's either a publicly traded investment management firm, and there are really only a handful of those out there because of the cost of being public. It's rare to see an RIA with under, say, 20 or 30 billion in assets under management become, or just to make it economic sense to actually be publicly traded. So it's and most RIAs obviously aren't of that scale, but we do see there's a handful of names, 10 to 15 publicly traded investment management firms out there. So that does happen from time to time. We also see it oftentimes with trust companies that usually have more onerous capital requirements. Sometimes some of their larger high net worth clients will provide startup capital to start the business. And same with multifamily office firms. Obviously, they're dealing with a lot of high net worth or very high net worth clients, and sometimes they will provide, a group of them will provide outside capital. But it is rare, the external widely distributed model, but we do see it from time to time. So when we're working with clients on their succession plan, we often have to help them decide which one is best for them. And there's no magic bullet or one size fits all optimal solution for everyone. It really depends on their own situation, and they have to think about the various pros and cons of each of these ownership models. So I think starting with the first one, the internal concentrated ownership model, I think the benefit there is fairly obvious. The insiders, which own the founder, the founding principals, typically own 100% of the business. They're actively involved in the business. So main benefit there is they have complete control or autonomy, complete control over the firm's operations. However, if it's only one or two individuals that own all the equity and control the decision making, you have to question the firm's endurance beyond those individuals. And also, there's not much scalability at that size, and employee retention may suffer if the other employees don't have any equity in the business. So moving down into the internally owned but widely distributed ownership base, one of the trade-off there is from coming from an internally concentrated ownership model is that obviously with several shareholders, you're going to be, as a founding principal, you will be giving up some of your control prerogatives by selling to the next generation of management. But what you pick up from that is that the business is more likely to survive your involvement if other shareholders, if the next generation of management has an ownership stake in the business. This widely distributed owners internally operated model, obviously not the most scalable, but it does help with employee retention because again, there's a broader group of owners. That next generation of management and key advisors has equity in the business, and they're more likely to stick around. The flipping to the going down the list here, the externally concentrated model. The advantage there is because you're owned by usually a PE firm, or particularly in the case of an RIA aggregator, that could be a very scalable model. These are well-capitalized buyers, help with financing, but they also, in many cases, they can help with distribution of, in the case of an asset management firm, they may be able to help with the distribution of your investment products or strategies. And for wealth managers, maybe they can grant you access to clientele that you ordinarily wouldn't have access to, or geographies that you may not have access to. So that model does help with scalability, but again, with no employee ownership or very little employee ownership, employee retention, and perhaps the endurance and certainly the control aspect you're giving up when you're majority owned by an outside buyer. The externally distributed model, similarly, that tends to be a more scalable option. It's good for endurance. The ownership question is sort of, at least from an equity standpoint, already figured out. But again, you're losing control. The insiders have no equity or very little equity, and that could also hurt employee retention. So again, there's no one size fit all perfect solution for everyone, but you need to be thinking about, and this is not an exhaustive list, but you do need to be thinking about the pros and cons of each of these ownership models. So how do you get from one ownership structure to another? And again, this is certainly not an exhaustive list, but we do have a fair amount of examples here. So if you start on the left-hand side of the page, and usually what we're doing with clients and helping them with their succession plan is one, weighing the pros and cons like we did on the preceding slide, and then helping them, what's the most reasonable pathway to get to that ownership structure that makes the most sense for your firm. So one of the more common pathways that we deal with, and most common for most RIAs, is going from an internally concentrated model of just a founder and a founding principal to a more widely distributed ownership base. And that can be accomplished in a number of ways. The installation of an employee stock ownership plan, there's some equity comp incentives, but usually that occurs with the founding principals selling to the next generation of management and leadership over time, usually at a fair market value price. And that's a very much a gradual process, but that is a very common pathway from becoming an internally concentrated model to a widely distributed internal model. If you're going from internal to external, internal to externally concentrated, that's almost always going to involve a sale to either a financial buyer, usually that's a private equity firm, or a sale to an RIA aggregator. That's usually the founding principals. Sometimes it's the key shareholders or the key managers in the business are selling out to an RIA aggregator firm or a private equity firm. When we're going to the externally distributed ownership model, there's really only two paths for that. You're either going public through an IPO, or you're selling to a syndicate of buyers, usually high net worth buyers that are also clients of the firm. That's the typical pathway to getting to the external distributed ownership model. And again, we don't see that often, but it does happen from time to time. If we're talking about going from an externally owned firm RIA to an internally owned RIA, again, that's slightly more rare, but usually that's accomplished by some sort of MBO or management buyout. That's usually a few of the key managers or principals of the firm buying back the equity from an aggregator or a private equity firm, whatever the case may be, and taking over the ownership and also obviously the management of the firm. So that's typically, there are other ways to do it, and they usually take on debt financing to do that. But that's usually the pathway from going from an externally owned business to an internally owned RIA. Excuse me, went the wrong way. Excuse me. So I alluded to the most common pathway from going from an internally concentrated model to an internally widely distributed ownership base. So that's a very common pathway that we see when we're working with RIAs on their succession plan. So most RIAs start on the left-hand side of your page here. They start something like this. It's usually 100% owned by, at least at inception, it's 100% owned by the founding principal and maybe some degree of outside capital. But it's almost always the case. The founding principal is going to have a substantial form or substantial percentage of the overall equity in the business. A few years later, once the firm is grown in scale, they've hired more people. Usually what you see over time is the other employees, particularly the key employees, buying down that founding principal, usually over 5 to 10 years, whatever the case may be, but they're typically buying down the equity over time. And they're also, if there's any outside capital, they're also buying down that owner as well. And the ultimate goal typically is for basically the cap table to be completely inverted, where before it was initially capitalized by solely the founding principal and maybe some outside buyer and 0% other employee ownership. The ultimate goal is for that to be, at least in trying to transition to a widely distributed model, is in becoming 100% employee owned or something very close to it, with the founder and the outside capital provider either being completely bought out or having a very small percentage of the firm's overall equity. So as you can imagine, this takes several years to accomplish, but this is usually the end game when we see that common pathway of going from an internally concentrated ownership model to a widely distributed model. And so here we're just using an example from the HBO series Succession. So when we're working with clients on their succession plan, typically we're asking the founding principals as part of that process, where do you see yourself in 10 years? And usually they say on a boat or a golf course. And so we take that to mean that they want to be completely out of the business in 10 years. And so if they are completely out of the business, their equity ownership and obviously their management and their client responsibilities should be zero. So that's at least gives us a starting point and kind of diagramming what their ownership should look like over time, as you see on this page. And so if we think, okay, in 10 years, they want to be completely out of the business, what should their equity ownership be in, say, 5 years? And usually what we hear when we ask our clients that is they'll say, Well, I don't want to be as involved as I am now, but I still want to have some level of involvement. And so that gives us at least another reference point. So in that situation, let's say they started off with 60% equity. If they want to be completely out of the business in 10 years, we say their equity should be, at least in theory, 0%. And maybe in 5 years, their equity should be 30%. And also their client, as Matt alluded to earlier, their client responsibilities and also the managerial responsibilities should gradually decline with their ownership over this time. So here we've got an example. In this case, this is very much an internally concentrated firm. This is ATN from the show Succession. And if you've seen it, you'll recall that Logan Roy been with the firm for quite some time since he founded it, and he was 80 years old in the pilot episode and in very poor health. And so here we're dealing with actually a more truncated timetable, call it 5 years. So an 80-year-old 100% owner that needs to get out in 5 years. Ideally, what you would do is gradually have him transition out of his shares over time. So in this case, if he needs to be out in 5 years, we're recommending that he sell 20% of his equity in the business over time. ATM, much like most RIAs, is probably too expensive to buy in 1 year and certainly by one individual. So here we're selling to other key managers of his firm. And just like we would with a typical RIA, you're selling your interest over a time period. Here we have a truncated timetable, but usually it's over a 5 to 10 year period. And you're selling to other key managers and advisors over time. So this just gives you kind of a visual example of what this looks like over time. It's really up to you, depends on the RIA and the situation they're in. And we would recommend that you do this at least over a 5 to 10 year period to fully transition your equity over time.
I guess an additional lesson from Succession, which does fit the theme of today, is that the show illuminates that there's typically a lot of angst and drama involved in succession plans, and that's one reason why people typically would kind of rather not do them. And there's a myth in the industry that you really don't have to worry about succession or succession planning if your expectation is that you're going to sell your firm. We don't agree with that, and I'll give you an example. We worked on a dispute here many years ago where a wealth management arm of a large commercial bank bought an RIA, and in their due diligence, they only spoke with members of the founding generation. Literally a day after the deal closed, Generation 2 walked out and started soliciting clients. Now, they didn't get everyone, but they quickly set up a significant competing RIA across the street. As you might imagine, this was in violation of their non-compete and non-solicitation agreements. So litigation ensued and ultimately settled several years later, and a lot of dollars of legal fees later. Now, despite that settlement, the aggrieved parties could never truly be made whole because the selling firm was irreparably damaged by what had happened. Now, as I said earlier, this was many years ago, and today buyers are much more sophisticated. If you're planning to sell to a professional buyer, they're going to want an RIA that has a real business continuity plan in place. Without it, you're essentially selling a fixer-upper, and those aren't worth as much. Value is ultimately a function of expected future cash flows, and emphasis is on the word future. If your next generation is truly prepared to continue the business for, say, the next 10 years or plus or more, and even better if they're personally invested in continuing the business, you're going to be paid more by an outside buyer. Most external buyers want a financial relationship with their acquired firms. They don't want to have HR headaches coming out of the gate. And if a substantial portion of your deal consideration is in an earnout, which it often is, you're not going to want that either. Succession planning matters whether you plan to sell your firm externally or internally. The issues are largely the same. So one thing every succession plan involves is valuation. What is your firm worth, and is it worth more to some buyers than others? Much earlier in my career, we battled common misunderstandings about the value of RIAs because many people in the investment management industry thought their firms could be valued based on some kind of rule of thumb. The market isn't simply based on a given multiple of AUM, revenue, or even EBITDA. The comparison showing on this slide tells the story of price to AUM and how 2% of AUM can mean very different things relative to profitability. Now, with normal fee schedules and margins, 2% of AUM can be pretty realistic. But what if the fee schedule is much less? What if the margins are poor? Under those circumstances, if you assume a set multiple of AUM, in this case, 2% of AUM, results in value, it's going to get you to a number that based on profitability, that makes no sense. 50 times EBITDA for an RIA is a number that nobody is going to pay. So we don't deal so much today with rules of thumb as we did at one time, but it still comes up. Even today, the common perception is that valuation is the easy part of a succession process. Maybe because we spend so much time dealing with the nuances of valuation, we don't think it's all that easy. Today, the misunderstanding about the value of an RIA mostly comes from industry press about transaction multiples. Now, this is a fairly meaty slide, and I'm not going to try to cover all of it. But the point of it is that a deal that gets reported at 15 times EBITDA oftentimes is anything but that. Because if you look at one, what's the actual value of the consideration being offered, meaning, yeah, the upfront cash, say $5 million in this case, that's worth $5 million. But that earnout that could be a maximum of $5 million over several years, between the risk of not achieving it, and it's not always achieved, and the time value of money, if you risk adjust and time value adjust that earnout payment, that $5 million compresses pretty quickly. In this case, we're saying $2 million. Then what about rollover stock? If you're getting a hefty part of your consideration in rollover stock and the entity into which you're rolling over doesn't monetize for a long time, is based on a valuation that is in itself inflated, ultimately monetizes in a market that's not as favorable as it is today, that $5 million in posted value or assigned value for the rollover stock, that $5 million could be worth a lot less. If it's only worth $3 million and that earnout's $2 million, then the deal that supposedly went off at 15 really sold at 10. And cutting that back again, the 15 times trailing EBITDA that you received could only be worth about 10 times relative to the actual economic value of the consideration paid. Now let's talk about your EBITDA. When you send your sim out and you're showing your trailing 12 EBITDA to be some significant number, well, you look at multiples maybe based on that trailing figure. But as time wears on, and by the time you get to deal close, the trailing EBITDA might be a lot higher. And in fact, the run rate or ongoing EBITDA number could be a lot higher than that. So 15 times, in this example that I'm showing in the slide, 15 times EBITDA is maybe 10 times if you look at the economic value of the consideration received. And if you look at that consideration relative to run rate EBITDA at the date of close, it could be worth, say, 8 or 8 point something times EBITDA. The story with transaction multiples is there's a lot of incentive on all parties to inflate the numbers. The sellers want to be able to tell their friends that they got a big number. The investment bankers certainly want to be able to boast about the size of the multiple that they got for their clients. And even the buyers are okay with big multiples because that makes other potential sellers willing to talk to them when they call up. So there is a lot of misunderstanding about the pricing for deals in the industry. They are not as generous as people oftentimes think they are. When you talk to valuation folks about their role in your succession plan, keep in mind that they view the world of value very differently than insiders at an RIA or industry participants who buy and sell RIAs. When you think about the value of your RIA, you think of it in terms of investment value. It's what the firm is worth to you specifically. Your valuation includes all the benefits of ownership, including your job, not to mention the psychic value of being a founder. G2 buyers are thinking about their returns after the cost of financing and worry about things like mortgaging their houses to buy into the firm. Industry consolidators might consider how buying your firm will fit their portfolio, their strategic goals, returns to LPs in their fund, etc. Valuation folks like us see value in a vacuum. We develop values based on hypothetical conditions and hypothetical buyers and sellers. The standard of fair market value, shown here, has a place in succession plans as valuations that will be used for ERISA plans, buy-sell agreements, financing, etc., are all going to need an independent third-party perspective on value. But fair market value can be very different than investment value because in investment value, actual parties agree to actual pricing based on their own individual circumstances. Now, in our experience, there is a bridge between the worlds of investment value and fair market value, but it's important to work with valuation professionals who recognize that the useful constructs in valuation, which are widely accepted in the financial community, aren't necessarily applicable to RIA succession. A simple example of that would be sponsor-backed funds who make minority investments in RIAs. In the valuation world, minority stakes are typically thought to be worth less, sometimes much less, than someone would pay for control of an organization. We know that it doesn't always work like that in the RIA space, however, because the usual attributes of control that would cause someone to pay more, like synergies, aren't as present in the investment management industry as they would be in other industries. And the logic of buying minority stakes in RIAs, in which the operating ownership of the business stays engaged and motivated, means sponsor-backed minority investors may be willing to pay every bit as much as control investors. Another topic in which people raise about value in succession in particular is the extent to which internal buyers pay less for their minority stakes than external buyers do. It's true, but the truth of it isn't widely understood. Control buyers pay more because of synergies, because of competition for control stakes, because of access to cheap capital, and special deal terms. Insiders don't have the benefit of any of that, but they do bring something to the table in terms of institutional understanding and institutional memory, which provides value to succession that outsiders just don't have. One way to think about the discount that buyers get, inside buyers get that is that they many times bring more to the table than, say, a sponsor-backed outside buyer. An outside buyer has industry experience, but what they're really there for is the ROI. An insider can help you build the value of your firm over time and can be worth a lot more to you than a simple sponsor investor can do. Insiders can bring you something that's worth a lot more than just the check they write. As I talked about a couple of slides ago, the transaction prices paid by outsiders are often, almost always, overstated because their deal terms diminish the economic value of what they pay. So the comparison of insider multiples and the multiples paid by consolidators or outside buyers isn't always as different as they seem to be.
So as Matt showed on the last slide, there can be a fairly significant value discrepancy between what a strategic buyer would pay for your firm and how much you would sell to insiders in a transaction that could span several years, up to 10 years in the making. So the logical question is, why would you give up potentially that much money from a present value perspective and not sell to a strategic buyer, but rather sell internally to the next generation of management? And that's obviously a good question from an economic perspective, but really you would be giving up quite a bit if you went that route, as opposed to, say, a gradual transition to the next generation of management. Most notably is the autonomy or the control that you would have after the deal. There's almost, as you can see on this depiction here, there's a transaction trade-off. There's almost always an inverse relationship between the value or the proceeds you would receive in a transaction and the amount of control or autonomy you would have after the deal. So looking at the left end of the spectrum, a sale to another RIA or a strategic sale to another RIA would certainly, or in all likelihood, maximize the total value you would receive from that transaction. But after the deal, there's a good chance that you would have little or no control over the business, and there's a good chance the name, or the name on the door, your name on the door, might change shortly thereafter. The other end of the spectrum, whereby you're transitioning the business to the next generation of management, there are several advantages to that, even though you would probably be leaving a lot on the table economically if you go that route. But you would be able to handpick your successors. You would be able to, in all likelihood, you would continue working with the firm on its strategic direction, its growth after the deal is struck. Even after you've sold all your equity, you would probably have the ability to stay on if you like. So you would have more control over the future of the firm, more control over its future growth if you go that internal route, as opposed to a strategic sale to another business. And as you can see just on this depiction here, there are all sorts of options in the middle, that involve a sale to, say, a private equity firm or an RIA aggregator, patient capital, et cetera. There are all of these different options or transactions for your eventual exit from the business. They're all they're on this spectrum, or exhibit this trade-off between transaction value and your amount of control or autonomy after the deal is actually after the deal takes place. So how do you, if you are going, which we're seeing more and more of this pathway that I alluded to earlier, of an internally concentrated owner, that's usually the founding principal, selling his or her shares to the next generation over time. A natural question that we have, or that we get, is usually where we get involved, is how do you go about valuing those shares on a regular basis when you're transacting your ownership stake in the business to the next generation of management? And we would say, unsurprisingly, you don't. Typically, an insider or an RIA principal usually has a significant background in economics and finance, but they probably have never valued a business before. So they have no business value expertise to actually value their business. They also, unsurprisingly, and this is not just true of the RIA industry, this is true of really all industries, typically founders think their business is worth more than it actually is. And in that case, it's really difficult to transact your business to the next generation of management when you're at, say, a 15 to 20 times EBITDA multiple or something to that effect. Hard to strike a deal with the next generation of management. These are individuals that you will be working with down the road. Hard to get a deal done at that price. So that's usually actually when we get called in, is that the buyers and the sellers that are both insiders of the firm can't agree on value because, one, they lack the expertise. Also, they are heavily biased in the deal. So we are a third-party independent appraisal firm. We have, no ownership in the business, obviously, but we do have experience in valuing firms in this industry. We don't have to, we hope that there usually is an ongoing relationship and valuing the business, usually on an annual basis, but we are not working day in and day out with the buyers and sellers. So it's not, there's certainly no resentment or awkwardness when both sides don't agree on our number. And it's pretty typical for, say, the founding principals. Naturally, they think we value the business too low, and sometimes the next generation of management thinks it's too high. But generally speaking, they tend to agree that the number and the process are reasonable at the end. So again, not something you should be doing on your own, and you should go unsurprisingly, but we do think there's a lot of support for it, that you should be hiring an independent business appraiser to value the business, usually on some sort of regular basis. So when you're looking to hire a business appraiser, what should you look for? Well, there's typically two types of business appraisers out there. There's a valuation expert. Usually those are generalists that value companies in all industries over a general period of time, but they have usually extensive experience with valuation techniques, models, et cetera, and a good background typically in economics and finance. There are also what are known as industry experts. Those individuals may not have unique valuation expertise per se, but they do have deep familiarity with the industry, in this case, the RIA or the investment management industry. So those are typically the two types of business appraisers. And we think that for something this important, you really need a business appraiser that is both a valuation expert as well as an industry expert. You're talking about valuing what you've built typically over the course of your career, and it needs to be done right. So someone who is solely an industry expert, they may not have familiarity or expertise with more complicated or complex valuation models, most notably the DCF or discounted cash flow model that is the most prevalent, most typical model used to value investment management firms. They may not have as much expertise with that as, say, a valuation expert might. Conversely, a valuation expert that has little or no industry experience, may use what Matt alluded to earlier, that 2% of AUM figure. They may rely on rules of thumb measures that may not be applicable to your firm based on its fee structure, its margin, et cetera. Or they may not be aware of recent trends in the RIA industry. They may not have access to the transactions or the right databases to actually glean market evidence to support their valuation conclusion. So again, we think that you need both a valuation and an industry expert to value your business or when you're hiring a business appraiser. So one thing we don't do is financing for RIAs. We're not a bank, but we will say that this is very much an issue. As you all are probably aware, these businesses have grown. There's been a lot of interest in the valuation, the RIA industry. Those values have increased over time. We touched upon it in our last webinar on valuing RIAs. A lot of interest has driven up these multiples over time. That means these businesses have gotten more expensive to acquire. And hence the demand for debt financing to buy either an external capital provider out, either a private equity firm or an aggregator, or buying out the founding shareholder. And that's usually done by the next generation of management, internal owners. And one issue in this particular industry, or that is somewhat unique to this industry, is that most conventional banks will not lend for the purposes of these transactions in the investment management space. And that is because a lot of banks, a lot of conventional lenders are not comfortable lending to a business that has little or no fixed assets on the balance sheet, or not a tangible asset intensive business that they can use typically like to use those tangible assets for collateral. I'm guessing that on your balance sheet, there's not much in the way of tangible assets, but certain lenders, and most of which that you see on the screen here, recognize that this business does have good recurring AUM based off the assets that they manage on behalf of their clients. So these, call them more sophisticated or more intelligent lenders, they recognize that this business, the RIA industry, has a high degree of recurring cash flow. So again, we don't provide these types of services or these lending services. We do have relationships with individuals at all these firms that you see here. Happy to make the introduction, but if you try to go to the local commercial bank, for instance, if you need a loan to buy out an interest in the senior partner shares, in all likelihood, you will get turned down because they do not lend. They are uncomfortable lending to basically a professional service firm that does not have much of the way of tangible assets on its balance sheet that they can use for collateral. So that is kind of a unique consideration, and we're seeing increasing demand for loans to finance the acquisition of to either buy out an external capital partner or to gradually buy out the founding partner's interest in the firm. So in conclusion, succession is very much a process and not a single event. And we've found in working with firms on their succession plan that those taking the most time and thought into developing a viable succession plan tend to have the best outcome. So here, again, this is not a completely exhaustive list here, but here are some practical takeaways before we get to questions. One, start 5+ years before you anticipate stepping away. I would say it's at least that. You don't want to be in a situation that I alluded to earlier, where Logan Roy is 80 years old in bad health and still has 100% equity interest in the business. You need to start thinking about this well in advance of your retirement age, and we recommend that to be at least 5 to 10 years. Always, you're probably doing this anyway, but identify and mentor your next generation of leadership. And with the eye that they're not only going to be taking over the managerial responsibilities that you have, they're also ideally would be taking your equity, buying your equity over time, and assuming those key client relationships that you've developed over the years. And that's obviously a part of expanding equity ownership to key employees. Always be thinking about who your successors are. And as part of this, a succession plan is typically a written document. You need to document all the key processes. Your succession plan needs to clearly lay out how you're going to transition equity, management, and client responsibilities to the next generation over time. Or if you're planning an exit to a third party, you need to be documenting how you anticipate that being done over time as well. Always keep clients informed in this process. You don't want any surprises. Certainly for key clients that they've been working with one individual for 10 or 15 years or longer, and suddenly that individual goes away, they're not likely to stick around. So you need to be engaging with the clients. Usually we recommend a team approach as opposed to RIA clients dealing with one key advisor. But in any event, you need to be keeping them apprised that, obviously you're not going to be doing this forever, and that you will have that those financial planning and wealth management services will be taken care of after you exit the business. And then obviously you always need to be reviewing and updating your plan even after you finalize the succession plan for you and your team. And then I'll wrap up with what we call the transaction trade-off triangle. And really, that's just that in any transaction, there are three kind of key considerations of price, terms, and time. And in our experience, as part of any sort of negotiation, whether it's an internal or an external transaction, you're never going to get all three exactly to your liking. So we'd always recommend prioritizing two of those, maybe at the expense of another. So just another thought when you're thinking about or you're getting closer to a transaction, what are your priorities in this deal, with the recognition that you're not going to get everything that you want. So you need to prioritize. What we recommend is prioritizing two at the expense of the third. And so I think with that, we can turn to questions.
I thought I'd unmuted. I was going to say we've got a few questions here. And if you've got anything else you'd like to know from us, type your questions into the Q&A box below, and we'll answer it as best we can. But I see a few here. Let's see. Here's one. I think I can figure this one out. You discussed the fallacies of an AUM-based rule of thumb measure to value RIAs. What other methodologies or key factors do you consider when you're valuing a RIA for either a sale or an internal succession? So again, in our world and sort of the vacuum that we live in, there are three approaches to value primarily. There's asset, income, and market, and balance sheets of RIAs don't usually mean a whole lot, so the asset approach doesn't get a lot of use. Market approaches are tricky. As I said earlier, there's a lot of transactions data out there, but seeing through that transactions data to get down to the real economics of what was paid and what the performance adjusted pro forma of the acquired entity is takes some work, and it's certainly not typically visible from the public disclosure about a transaction. Now, we do keep track at Mercer Capital, we keep track of transactions that either we were involved in or clients of ours, such that we're aware of kind of all the nuances of pricing, so that we can use that data for some of the work that we do. But publicly disclosed data isn't great on transactions. There are some publicly traded investment management firms, as everyone knows. There again, it can be tricky to draw inferences from a large public RIA to, say, a wealth management firm with a couple billion under management. And in general, I will say that the investment performance or returns to owners of a lot of smaller RIAs, the closely held ones that are typically clients of ours, versus, say, a Franklin or something like that, one of the public companies, usually it's not uncommon for us to see our clients ultimately providing better returns for their owners than the public group. A lot of the public companies, their operating cash flow goes, about half of it to distributions, a large portion of it to executive comp, and another large portion to transaction acquisitions, which don't always work out. So the public group can be kind of nettlesome to interpret vis-a-vis a closely held business. That leaves us with the income approach, which is, of course, a DCF. And most buyers, sellers of RIAs lean more heavily on the DCF models, some kind of projection models, than they do anything else. And in an effort to mimic or mirror that behavior, we do the same thing at Mercer Capital. I think you can, these are cash flowing, growing businesses a lot of the time. And you can model that and understand the implications of your assumptions and what you think of the business a lot more clearly with a DCF than you can with market approaches. And so we rely on that, not exclusively, but very heavily. I think what the market approach tells you, and a lot of times, is it gives you some boundaries to what outcomes should be with any income approach, and you can sort of compare and contrast and learn something from the relationship between those implied values. And that goes for either RIAs that are going to sell externally or internally. The perspective on the buy side is usually one of expected cash flows. And for the sellers, of course, that's what they're giving up. So it's relevant to them too. So we use DCF models a lot. Okay, let's see here, Brooks. This is about a slide you showed, Brooks. It says you spoke earlier about the trade-off between value and autonomy. Yeah, that's for sure. In a strategic sale versus an internal transition. What are some of the other pros and cons of internal succession versus selling to an external buyer?
Yeah, I think, something I didn't touch on earlier is, and something you should always be giving thought to is, how are your other employees going to view a sale to a strategic buyer? This can be if suddenly they have, especially if they have no equity in the business or they're not getting cashed out in this deal, how are they going to feel about potentially having a new boss and a new owner? And maybe even a new name for the firm. And what is that going to do to their client relationships? Now, this is probably something that the buyer is going to be very interested in as well. And will usually, as we alluded to earlier, there's usually some sort of earnout that requires the owner to stick around, or at least is incentivized to stick around for some time. But in many cases, that is an exit strategy for the owner that would maximize value, that being a strategic or even a sale to an RIA aggregator or PE firm. Um, but you have to think about how are your other employees, in some cases, the RIAs we work with, those are individuals that you've worked with for 20 or 30 years. How are they going to view that? And sometimes they may be okay with it, especially if they have equity. But if you think back to one of Matt's slides, one of your slides, Matt, that's why we oftentimes recommend that there's some sort of either equity comp or some sort of sale to or internal transition before an outside sale to a strategic buyer. One, that makes sure that those other key employees have some stake in the game, some equity in the sale price. And also, I think, and kind of what you alluded to earlier, is that strategic buyers probably going to be more attracted to a transaction where the next generation of management is incentivized to stick around and potentially maintain their equity in the business, or maybe they sell out, but also at least be on board or have been involved in the company's operations over the last few years, or significantly involved in the last few years, and are more likely to stick around in the foreseeable future. So didn't really allude to it earlier, but I think you have to be key consideration is how are your employees going to view this deal? And you need to be thinking about that in advance. Do I grant them equity? Do I sell equity to them? Do I provide equity comp incentives? But at the very least, you need to be talking to them about that transaction and what it might mean for the firm.
And we've certainly seen situations where, say, a sponsor-backed fund got involved with an RIA and helped finance the buy-in of some of the G2 folks at the same time, so that there would be, some distribution of ownership with the revenue producers, and obviously the magic phrase alignment of interest. Let's see. Here's one. This must be a question also about internal succession. It says, I understand the difficulties of obtaining debt financing. There do appear to be some options available out there. What about balancing the financial needs of retiring owners with the growth objectives of the next generation? Yeah, exactly. A transaction is a transaction, right? I mean, the sell side is giving something up. The buy side is taking something on, and in exchange, the buy side is giving consideration, and the sell side is receiving it. So, one way to talk about balancing those needs, really does go back a little bit to what you were just saying, Brooks, that it works well. It seems to work well when these transitions happen gradually, when succession is treated as a process and not an event. And you've got sellers, you've got the controlled generation selling down over time, and the next generation buying in over time. There are multiple ways of doing that. Equity compensation is certainly one of them. There's not a lot of use of ERISA plans like ESOPs in the industry, but a few are out there, and we've seen those put to work successfully. Retiring owners can receive, money over time by self-financing the sale of their interest. Maybe they want to maintain some continuing stake. Maybe they want to accept something that looks a little bit like an earnout, even if it's an internal succession, and that de-risks the transaction for the buyers. But there are any number of ways, depending on the specifics of the individuals and what they want, to balance. I guess, given the way the question was phrased, to balance those needs of the retiring owners with the growth objectives of the next generation. Kind of no way around thinking about how the next gen, they're buying the right to own the growth that they put into the business, and that makes sense. And the sellers are getting the benefit of the growth that they created back in the past. So it's certainly a doable thing. but talking about it, in the abstract is not as significant as actually getting in to a particular situation, looking at each side and deciding what they want to do. Okay. I think we got time for another one before we run out. Brooks, this one says, when you work with these firms, I guess they mean our client RIAs, what common mistakes do you see RIAs making in succession planning, and how do you help resolve them?
Yeah, I think, and Matt, you probably agree, but I think the most common mistake we see, and something we alluded to earlier, is waiting too long.
Mhm.
We use that example, not from Succession, not just because of its play on words, but in that instance, we are dealing with, and sometimes it was an extreme example, but sometimes we do see this situation. That was an 80-year-old individual who still had, in poor health, who still had 100% ownership in the business. When we see that, and it's maybe more common than you think, we don't ask, but that's obviously something they wish they had taken care of well in advance. And they put it off sometimes there's good and bad reasons, but they put it off. It's not just true in the RIA industry, it's probably true in almost every industry, but this is somewhat of an aging industry. Certain clients are aging, and we do run into it quite a bit where they simply waited too late. And that usually, under those involuntary transfers that you alluded to earlier, that's a suboptimal outcome that you're dealing with when you wait too late. It's not just bad health, it can be a shareholder dispute, a partner gets divorced, a whole lot of things, but you need to, in any event, it's always best if you plan for something. And that's really that's the whole idea behind a succession plan. I think another one may be, underestimating client concerns. Your slide, Matt, you loaded, there's really three aspects or components to a succession plan. It's not just transitioning equity, it's also transitioning client responsibilities over time and managerial roles and responsibilities. Another critical mistake we see is that a succession plan doesn't cover all three. And I would actually say a lot of times they don't. They're only covering, sometimes management and equity. Well, if you don't transition the client relationships, that's what's driving all the revenue. So you don't really have anything. The equity isn't worth a whole lot if you don't transition the client relationships. And that's maybe obvious to some folks, but a lot of firms don't really think about that. And especially if those clients really identify more with a key advisor that's getting on up there in years instead of the firm, then there's a high risk of losing those client relationships when the advisor retires. So you need to be thinking about all aspects of succession planning, not just equity, but also transitioning client and managerial responsibilities. And I would say also, one of your slides, Matt, was about most RIAs don't have a formal succession plan, or they haven't even begun the process. Well, even if you're starting the process and you're thinking about, you're having meetings about, there needs to be a written document. This is part of that you can allude to and monitor and change and et cetera over time, but this needs to be formalized or documented sometimes. And sometimes it's really not. We ask clients about their succession plan. They say, yeah, well, this person's going to take over for him or her, and they're going to move on. But it really needs to be documented. It needs to be ideally part of your overall strategic plan if you have one, but it's very much it needs to be in writing and not just kind of a general understanding, because that gets confusing or doesn't get communicated to all the relevant parties. I don't know if you had any to add, but those are kind of off the top of my head the three most common issues that we see when clients go or mistakes they make with their succession planning.
You don't see a lot of circumstances, and when I say I'm understating or overstating the case, I can't think of an example of a succession plan that started too quickly or too soon or too early. Lots of people wait too long. Lots of people think it's going to go faster than it actually will. Remember, we were at a conference, and there was a little bit of a polling in the audience of succession plans, and people were asked how long they think it takes for a succession to happen. A handful of folks said 10 years or more. I don't know that that's necessary. I think that would be pretty dispiriting for a lot of people if they thought that it was going to take that long to do it. But the 3 to 5 years is not at all unusual. And if you think about it, when sponsor backed transactions happen, it's not unusual for them to have 3+ year earnouts. Well, it's kind of the same concept. So it takes a while to actually transition the clients and the relationships and the expertise and the leadership and the ownership of a firm. And so it's worth thinking about early and often. So that's if there's anything that I would hope people would pick up from this, it would be that.
Yeah.
We've got other questions, but I think we pretty much need to call it on time at this point. I think we've got to turn it back over to Sarah with a little bit of housekeeping on the back end. And Brooks and I want to express our appreciation for everyone tuning in today. It's been fun, and I hope you've gotten a lot out of it. If you've got any follow-up questions that you want to talk about in more detail with us, look us up and we'll talk more.